Today's episode, I am going to talk about time invested in monkeys. Hey, young lady, let me get the mic out of here. You want to say hi to everybody? Welcome, Frugal family. Happy Chinese/Lunar New Year today. It is going to be the year of the ox, and I just hope that, as my mother say, I become less stubborn with age. But I just want to give a well wish to everybody out there. Happy, healthy New Year. With that said, today I'm going to talk about time invested in the market and how compound interest can do you some really good things in terms of growing your return and your portfolio. So what I have here today is a little piece of crib note that I wrote because this video is for Cameron. Cameron, I know that you are just graduating high school and that you have come into a stash of money. I'm just teasing. I think you are starting off with a small portfolio, but like everyone here in Frugal Power, we all have small steps that's gonna give us big leaps in the future. So I wanna dedicate this video to you, and I'm gonna talk to everyone about how we start small. The first thing I'm gonna talk about today is how I started in 1997. I am going to take you through the first $1,000 I invested in 3 companies and what I did with that, how that would have grown in 24 years to present day. I took a look at some of the stock prices before the market today. I did some rough calculations that I'm going to share with you guys on the screen, and you can take a look what that looks like in terms of growth. And Cameron, if you're investing $1,000 or even more, I want to show you what that would look like if you are 18 now, by the time you retire at 65, what that would look like for that $1,000 you have invested. And the third thing is I want to talk to you about diversification. You can take a look at my other video about diversification and take a look at some of the tips about getting started and how not to put all your eggs in one basket. You want to maximize your return and at the same time balance your risk. You have a lot of years ahead of you, and by my calculation here, if you're 18, you retire 65, you got 47 years for compounding to do some really good work. And I'm gonna take you through what that would look like at 7% interest. Let's go through number 1. So now that you're starting small, you have $1,000. I'm gonna share my screen right now with everybody that's watching. This is what I have. So I follow Buffett's advice. So this was me in 1997 in college. I believe I was a sophomore or junior at that time. I had started studying economics, decided to major in it because I was failing at becoming a doctor, could not pass organic chemistry or even chemistry. For God's sakes, I just didn't know what the heck I was doing. So what I did was I started investing the money that I was making at night. I was doing a little bit of work at night, and I came and I started saving. I was brown bagging my lunch, and in the spirit of our channel, Frugal Power, this is a small tip that you can do. Bring your own lunch when you are starting out. It'll help you save money a long way. I started reading articles in Money Magazine. I remember Warren Buffett saying, invest in companies that you like and that you know things about. So in college, I loved Nike sneakers. So what I did was I took my $1,000, as you can see here, and what I did was I divided into 3 buckets. Diversification, that was my first lesson. I invested $333 in Nike. Microsoft was something that we used in the computer labs. I was writing my term papers on Microsoft, and I said, ooh, everybody must be using Microsoft. So I invested in Microsoft. And then I read about this company, was this company called KLAC. What they did was in semiconductor manufacturing, they made all the equipment of making the chips. So all the chips that went into computers. We didn't really have cool cell phones like now. It was like a Nokia, I believe, back then. And I said, those look like good companies, and I am going to invest my money in there. So I divided the money into 33% each. And as you can see, I put a total of 25. I had Nike at that time was trading at $25 a share, and I bought 12 shares. It came out to about $300. Microsoft was $32 at that time. I went back in the history to take a look at the historics at that time, so I may be off by a few cents. And I could buy 11 shares that total $352, and then KLA was trading at $48, and I invested 7 shares, and that totaled $336. When you add all that up, it came up to the $992. And then I took a look at what the value of the stock would be now. Nike's about $144. My money would have been $1,728, Microsoft $240, and my portfolio for Microsoft would be $2,640, and then KLA would be now $326 a share. Amazing. I would have $6,520. So all in all said, I would have 10,888. 3/8, what a lucky number. And that return would be 1,000%. I divide that over 24 years, my average annual return would be 41.75. Not bad, as an example. Now, the only downside of the story was I needed money when I was working, and then I started working, I had cashed out and I sold some of my positions. What I want to share with you as this chart of KLA as an example is that you will see that there will be ups and downs in the market, but long term, if you hold it, you buy good companies, you hold it, good things are gonna happen. The last thing I wanna do, I want to talk to you a little more about why I have the yellow here. I wanna go back to this chart here for a second. So you can see the ups and downs, but overall it's trending higher over time. With KLA, the reason I put a yellow mark over there in this is we never know what happens with general market dynamic. And it's interesting that the semiconductor market has been taking off, and that's due to a shortage of chips and semiconductors from everything that you have, from cars that need it for self-driving, autonomous vision, all these things, to your PlayStation or your Xbox or to your cell phone. So this is something I read on CNBC, and I just want to share this with everybody. And the title of this article from a couple of days ago is why there is a shortage of chips that's hurting everything from PlayStation to cars. I'm gonna post the link down there if you guys want to take a look at what's going on. But the reason I'm mentioning this to you is, Cameron, look at the market, look at the companies that you invest in, and look at the trends in the market. That's one of the first lessons I've learned. There will always be cycles of up and down, but always read and enhance your knowledge so that you can make sound investment decisions. And I will tell you from my short period of investing that we will never be able to see what's going on. Even the best, like Warren Buffett, he cashed out of his positions in the airlines, probably for other reasons. But if you actually held your airline stocks through the dip from March of last year, you would probably be up between 50 to 70% on a whole, on average. What I want to tell you here is that hold the stock, hold good stock through time, and you will get very, very good return. Now, the last thing I want to talk to you about is what your $1,000 hypothetically would look like. And I did some back of the napkin calculations for you. Given that you have 47 years ahead of you, your $1,000, if you were to divide it into 80-20, which is 80% in solid, good companies, blue chips perhaps, diversify your money into good sectors, good ETFs, and then 20% for something that you are very interested in, something that's going to be a little more risky. You have time on your side. You'll see that your money will grow tremendously over time. Now, I'm going to talk about the 7% rule. This is something that Mr. Jack Bogle talked about. He's the founder of Vanguard. He said that if you were to invest your money and you get a 7% rate of return, your money will double every 10 years. I'm gonna say that you have quite a few cycles of doubling. I'll give you an example. You will have $2,000 after 10 years. Your 2,000 will double, become 4. 4 will double into 8. And the last compound cycle, you will have 16. So that could be 16,000 or it could be 16 million. It just depends on how you will invest. So Cameron, I want to just show you what the math looks like, okay? With my calculator, let's do it together. You have $1,000 as your original principal that you have. Then we're gonna multiply that by your compound factor. There's a really big formula over here, but we're not gonna use it. We're gonna just do it the simple way. And you're gonna get 7% return. So you have 1.07, and you are going to raise that to the 47th power. That's your compounding number of years. That's 24 factor times your original $1,000 investment. Cameron, you are going to have $24,045.71. Congratulations. So keep investing, okay? This is how the power of compounding will look like in a hypothetical model. Now, I'm not advocating any type of investments. I'm just showing you the math and the science behind this. I hope this helps in terms of you understanding the power of compounding, time, market up and down, how to weather it. And then in closing, I just want to say, Happy investing. Good luck with your first portfolio. I know you will have many, many more. And I do have something else. This is a book that I have since I was in college. It's a little beat up. It's been with me for a part of my life. It's gone with me from New York to California and now to Florida. It's called Investing the Warren Buffett Way, Investment Strategies of the Greatest Investor. I figured, you know what? It's time to pass this on to someone else. I hope you will get a chance to read this, and good luck investing. And I hope you hustle hard towards your dreams. Have a great day.